equity. It's a word that gets thrown around a lot in the financial world, often leaving people confused, but you see, it's not as complicated as it seems. Think of a company as a delicious pie. Equity is simply your share of that pie. If you own equity in a company, you own a piece of its worth. It's your stake in the game. Now, you might be wondering, how big is my slice? That's where things get interesting. The size of your slice or your equity is determined by two main things: book value and market value. These are two different ways of measuring the worth of your piece of the pie. Understanding equity is crucial for anyone who wants to build wealth. Whether you're an entrepreneur starting your own business, an investor looking for opportunities, or just someone who wants to be financially savvy, grasping the concept of equity is your first step towards financial success. So let's dive deeper into the delicious world of equity and explore its different flavors. Book value is like taking inventory of all the ingredients in our pie. It's the straightforward accounting-based value of a company. Imagine listing out all the assets of a company, its buildings, machinery, cash in the bank, and subtracting its liabilities like debts and loans. What you get is the book value. Let's say you own a bakery. Your assets include the oven, the cash register, and the ingredients. Your liabilities are the loan you took to buy the oven. Subtract the loan from the total value of your assets, and you get your bakery's book value. It's a snapshot of the company's worth based on its balance sheet. However, book value doesn't tell the whole story. It's like judging a pie solely by the cost of its ingredients. While it gives you a basic idea, it doesn't capture the intangible elements that make a company truly valuable, like its brand reputation, customer loyalty, and potential for growth. For that, we need to look at market value. Market value is what someone is willing to pay for your slice of the pie. It's the price at which the company's shares are traded in the stock market. Unlike book value, which is based on historical data, market value reflects the perceived future potential of a company. Think of two bakeries. Both have the same book value, same ovens, same ingredients. But one bakery has a secret recipe for the most delicious apple pie in town. People line up for blocks to get a taste. This bakery, despite having the same book value as the other, will have a much higher market value because of its popularity and potential for growth. Market value is dynamic. It fluctuates based on investor sentiment, economic conditions, and the company's performance. It's a more accurate reflection of a company's worth in the eyes of the market. It tells you what your slice of the pie is really worth, not just what it costs to make. Shares and equity are often used interchangeably, but there's a subtle difference. Equity is the overall ownership of the pie, while shares represent individual slices of that pie. Think of it this way: you own equity in the company, and your equity is represented by the shares you hold. If a company has issued 100 shares and you own 10 shares, you own 10% equity in the company. Each share represents a small percentage of ownership. The more shares you own, the bigger your slice of the equity pie. Understanding the difference between shares and equity is important for investors. When you buy shares, you are essentially buying a piece of the company's equity. The value of your shares, and therefore your equity, will fluctuate with the market value of the company. Equity holders are the proud owners of the pie. They are the individuals or institutions who hold shares in a company. They can range from individual investors like you and me to large investment funds and even the company's founders and employees. As an equity holder, you have certain rights and benefits. You get to participate in the company's profits through dividends. You have a say in the company's direction through voting rights. And if the company performs well and its value increases, your slice of the pie becomes more valuable. Being an equity holder means you are part owner of the company. You share in its risks and rewards. It's a powerful position to be in, giving you a stake in the company's success. We've seen that book value and market value can be quite different, but why? What causes this gap? The answer lies in the intangible factors that book value fails to capture. Remember the bakery with the secret apple pie recipe? Its market value soared because of its brand reputation, customer loyalty, and growth potential. These intangible assets are not reflected in the book value, which only considers tangible assets and liabilities. Other factors can also influence the gap between book and market value. Economic conditions, industry trends, and even investor sentiment can impact market value. A company with a strong management team, innovative products, and a bright future will likely have a market value much higher than its book value. Understanding this gap is crucial for investors. It underscores the importance of looking beyond the balance sheet and considering the broader factors that contribute to a company's true worth.